So onto the remaining things that we actually circulated through our newsletter last week, and also what was previously announced by the government. What we've got is the big one is the PAYG credit. Now, where the measure announced yesterday by the government was quite expansive and really applied to all employees. The PAYG credit was limited to businesses with a turnover of less than 50 million. When we talk about turnover of less than 50 million, this is inclusive of associated entities. So even if you've got a number of commonly controlled companies or trusts in your group and you put them together, and if your turnover's more than 50 mil, you didn't qualify for the PAYG credit. Similarly, if you're a small Australian operation, but you had a parent company overseas and you aggregate together and are over 50 mil, you also didn't qualify. So that did knock some of our clients out of eligibility, but a lot still qualified. Now, the way the PAYG credit works is they effectively, it was 25,000, they increased it to 100, and it's really kind of a matching system. So whatever your PAYG withholding liability, which is your liability from withholding tax from employees, is for the period up to June 2020, will be replicated by the government and paid for the period June to September. Okay, so they're basically saying, we're going to look at this period for the next 3 months and mirror it and pay it to you for the following 3 months as well. The second tranche of payments, so the second mirroring I spoke about, doesn't seem to be predicated on you continuing to be in business or employing people. So they've just linked it to whatever you had in employee obligations as far as PAYG withholding is concerned for that first period. For those who are on a monthly withholding cycle, the calculation is 3 times the March withholding amount, so that they align the treatment with quarterly withholders. Because if you're on a quarterly basis, your March withholding would have included January, February, March. So if you're on monthly, they couldn't just include a one times March, because you'd be disadvantaged. You wouldn't have had enough withholding to get the same outcome. The first 6 month cap they work on is 50, and there's a collar of 10. So what they're effectively saying is, if you've got employees, and this is employees from, if you're an employer, more rather, at 12th of March, and you had people on your books, you'll qualify. And there's a collar of 10 grand that they'll give you for the first period of March through to June. Okay, so it's collar and cap. 10 grand collar, 50 grand cap. If you have more than 50 grand in withholding obligations over the period March through to June, it's still capped at 50 anyway. And that will then lock in the matching of that 50 over 4 equal periods, June through September. If you only got 10 because you're a smaller withholder, then you'll get the 10 in the second half as well. Now, a lot of people then came and said, oh, what if we suddenly put everyone on wages? Well, there's just a few things to be aware of there. Firstly, we've always had a part of the law, old Section 109 for companies, which is excessive payments to associates. So you're just got to be careful that you can justify why they're being paid a wage. Okay, it's not as if you could just pull a number and quickly put them in. Secondly, there's still an onboarding process now. So in the past, often you'd find sometimes you do a book entry, or even casual wages paid in cash were actually deductible. But that all changed on 1st July. So you've got to go through the full onboarding process with single touch payroll, TFN declaration, super contributions, etc. The AT will be doing cross matching. Thirdly, there are anti-avoidance provisions in the legislation. So the tax office knew that people were suddenly going down this road of trying to beef up their wages. So if wages have suddenly increased, or it's a change in characterization of how someone is paid, they will be looking at it and saying, okay, why weren't they paid wages in the past? Should they have been? Should we be looking back at prior years, etc.? Now, is not to say there aren't defensible arguments to the payment of wages. There are, but we would just warn clients that if you're going to suddenly bump up wages, be prepared for the question that will come back and how you deal with the question from the tax office on that one. Okay. So the PAYG credit, remembering, is actually tax free in your hands. So you get the doubling. So you're not required to pay the PAYG out, and when you receive it, it is tax free in your hands. So that's a big plus. If it were accessible, obviously there'd be an issue on, the government is taking with one hand, or giving one hand, taking with the other. In the case of people who have companies, just be aware that the PAYG credit coming in as tax-free will mean at some time in the future you have retained earnings in your company with no franking credits. So you will have an issue getting them out. But for most of our clients right now, that's very much a secondary thought. The primary concern is just staying afloat at the moment. So I think for all our clients, even those I spoke to yesterday on the previous measure, about the measuring on this time last year, and has there really been a 30% decline, and do I look at my invoicing? My advice to them was, in the current climate, you don't turn away work. You're not sure what government restrictions are going to be in place tomorrow or even next week. So if all of a sudden you've found that we go into a higher level of lockdown and you can't trade, the last thing you want to do at the moment is be turning away work. So continue to focus on your business is our advice to everyone. Okay, adapt to the changing market, adapt to changes in consumer behavior and environmental conditions under which we trade and operate. Look to adapt to those and to keep your business alive. That's really important. So these measures are here really by government to keep small business up, to keep people employed, because the alternative outcome of seeing the welfare queues grow and Centrelink queues grow will have a far long-lasting effect in terms of the social fabric. So that's why the government's intent is really to keep as many people and businesses alive during this period. Now, some of the other measures I'll talk about. The other one is the immediate write-off for assets. That was increased from 30 to 150 grand up to 30 June this year. Again, the usual rationale for this is to bring forward capital expenditure. So if you do have capital expenditure to incur, then this measure means you get an upfront tax deduction for it. The clients I've been speaking to at the moment with the uncertainty aren't generally in a rush to go out there and buy capital equipment. But if you do have an impending capital equipment outlay, an item plant that you need to buy for your business, you can take advantage of this. The key is it's got to be installed ready for use by 30 June to get that uplifted 150 grand threshold. I just remember with cars as well, I often get asked this question, what about the car? Can I go buy the BMW or the Mercedes for 100 grand? And I say, unfortunately not. With cars, there's special rules around cost limits. It's about 57 odd plus GST. Any excess above that, you can't claim depreciation on. So just be aware that. Along with that, there's some accelerated depreciation for assets that are purchased, which give you additional write-off up front. So it's really front-loading the depreciation on that. Again, for a lot of businesses, I think this will be something that we come to at year end when we come to do the accounts and tax returns for clients. We'll be talking about, okay, do we use the accelerated depreciation or not? Okay. For most clients at the moment, it's really a matter of survival. Now, another one is the what we're hearing about the tax office and effectively the amnesty they're giving on repayments. Our individual dealings with the tax office indicates that they've got direction from above. So when you deal with the tax office, often what you find is their tone and what they give you in terms of payment terms allowances is very much directed from above. And in this case, the direction very clearly from above is you to give people 6 months. So already speaking to the tax office in terms of payment deferrals, payment plans, debts, etc., we are seeing that they're willing to do 6 months. Tax office generally saying, contact us on 30th of September and we'll speak again. Let's see how you go. Okay, so that's good news. Similarly, the Prime Minister mentioned on Sunday that he's placed a moratorium on commercial and retail tenancy evictions for 6 months, along which the APRA have also loosened lending guidelines for banks. So you've got landlords, you've got banks, and you've got the tax office all getting direction from government saying this number is 6 months. So we'd be advising all our clients, get on the phone, speak to your landlord, speak to the bank. If you've got payment arrangements at the tax office, speak to the tax office. In times like this, cash is king. So cash flow is going to be very important to keeping your business alive, particularly as your clients themselves begin to experience financial difficulty and inability to pay. You need to be working with your key suppliers, your landlord, your bank, to ensure that you ride this out. Also remember that in the current environment, landlords, they don't want to evict you because the likelihood of them finding another good tenant in the current market is going to be difficult. And if your business goes under in 6 months' time, there's great uncertainty on whether they'll be able to fill the tenancy. So landlords and clients work together. Banks similarly, banks don't want to repossess assets and try and sell them in the current market. It's not a great outcome. Neither do they want to become asset owners, like we saw out of the GFC in the US. Government-owned companies as forms of loans. Okay, it's definitely not an ideal place for government to be. So all the directions they're getting from above, and all the things they're trying to do are to keep businesses going. So definitely speak to all those people. Um, there is some temporary relief for pension payments. So I moved to super now. So the way super works is once you start drawing a pension, there's a minimum percentage of your balance that needs to be drawn every year in order for the super fund to continue paying it tax free. It starts at 4% and scales upwards slowly. Now, part of the measures have announced that that percentage can be halved, given asset values have been significantly impaired as a result of all this. So that's good news because for clients, if they're forced to pay the full amount, call it 5%, say for example, but asset values have decreased and there's lack of liquidity, that could cause a compliance issue with their super fund. So that's something to be aware of. Now, secondly, if your super fund owns your building, we've got some direction from the tax office through their frequently asked questions that you can actually have a rent reduction to your related business. Okay, because they're saying, well, if you were if you were negotiating with a landlord who wasn't your super fund, you'd have the same available to you. So why shouldn't your super fund be able to do the same? So that's also good news, okay, because concern over compliance is always an issue. And the third one is this withdrawal from super. Okay, now the stats we're seeing is a lot of people have applied for this already, and what it is this withdrawal of a small amount, about 10 grand out of super. Really broadening of what we might have previously referred to as the financial hardship provisions. Now, as always with this sort of thing, we'd caution against it. You need to get advice from a financial advisor whether it's wise to do this. Now, there's obviously a flip side to this. If you're going to be destitute living on the street and you can't buy food, then obviously that takes priority over do I withdraw money out of super. That we understand. But for anyone who isn't in that situation, particularly with these new measures that have been announced that will see people able to continue to be paid or the additional welfare payments, we think very carefully about withdrawing out of super. On a macro level, You're also likely to see liquidity issues and further impairment of assets if there's a need for fund managers to begin liquidating to make these payments. So long-term cost is there, and on a case-by-case basis, you really need to be speaking to your financial advisor or getting some specific super advice before you withdraw. Okay. Um, that's really what we've got. I'm just seeing if there's anything I've missed here. Okay, I think there's one more thing. I'm just gonna bear with me a sec. I'm just gonna open up my other fact sheet here, and this is in regards to okay, so ATO payment arrangements. I spoke earlier about the the tax office giving the 6 months. Now that is predicated on one thing. What they're saying is they want everyone to have their lodgements up to date. Okay, so they will give you this, and from what we're seeing, for example, with the deferral date for the March 2020 BAS is actually 14th of September. Okay, so you're seeing a long window they're giving you for payment here, but you do need to lodge and put the deferral request in, and then it'll be automatically granted. Okay, so I guess that's the update for now. Um, we'll be looking to do a few more of these, and in the next installment, once the legislation is released, we'll have something of greater detail around the JobKeeper payment from the government and any other new news that comes out between now and then. So to everyone, stay safe, keep well, stay at home, prayers to all. Thank you.